Hello, everyone, and welcome to today's tax reform webinar series. I guess this is our second presentation in the series, and today we're going to be focusing on choice of entity under this the new Jobs Act. So before we get started, there's just a couple items I wanted to address with you. This is Jared Frost, by the way. I'm our partner in charge of our mortgage banking tax services practice. All participants will be placed on mute. But, if you have any questions during the presentation, feel free to type those into the question feature in the webinar dashboard, and we'll do our best to address those near the end of the presentation. We're hoping that at the end we'll also have some time for Q&A, and so you'll have an opportunity to ask questions during that period. Should we not have time to address all your questions, we will follow up with you directly to ensure that your questions are answered following the webinar. And a recording of today's webinar and the slide deck will be emailed to all participants following the webinar. Just a disclaimer I wanted to read really quickly here. This presentation and related materials are intended to provide timely information about complex tax laws. The information provided may change as a result of Internal Revenue Service interpretations, the promulgation of new tax regulations, technical corrections to or judicial interpretations and rulings of existing tax laws. This information is not intended to provide legal, accounting, or other professional services and is provided solely for educational purposes. The information provided should not be used as a substitute for professional advice. If professional advice or other expert assistance is required, the services of a competent tax professional should be sought. Statutory and regulatory references in the materials are to the Internal Revenue Code of 1986 as amended or Treasury regulations thereunder unless otherwise noted. The materials provided in presentation may not be reproduced in whole or part without permission. And then quickly just talk about CPE. Today's webinar does qualify for CPE. In order to get the 1 hour CPE, you must answer all 3 poll questions that will appear during the webinar. You do not have to answer the poll questions correctly to qualify, but you must submit an answer. And following the webinar today, a survey will appear on your screen, and we'd appreciate it if you would complete that. CPE certificates of completion will be emailed to participants who qualify in the coming days. So a quick note about today's presenters. We'll have Josh Ratner, who is one of our senior tax managers in our mortgage banking practice, and Kenny Birch, who is a tax manager in our mortgage banking practice. And at this point, I'll go ahead and turn the time over to them.
Thank you, Jared. This is Josh Ratner. Here's a brief outline of what we're going to be covering today. I'll be speaking on the qualified business income deduction under 199A. We'll kind of go over the qualified items of income, gain, deduction, loss, the wage and property limitations, and what is a qualified trade or business, and specifically in regards to that, what is a specified service trade or business. Then I'll hand it over to Kenny, and he'll talk about the S2C conversion, the factors that you want to consider when making the conversion, the advantages of a pass-through entity versus a C corporation, and the details of what the conversion process entails. So jumping right into that, the qualified business income, first of all, it will expire in 2025. This is a little different than the CCorp tax rate of 21%, which is currently permanent. So what is qualified business income? It's net income from a qualified trader business excluding guaranteed payments. Just a note, W-2 wages received from an SCorp as an employee are also not included in QBI. Capital gains and losses are excluded. Dividends, interest income, unless it's related to the active conduct of your trader business, as well as qualified PTP income, REIT dividends, cooperative dividends, certain items of foreign income, amounts from annuities unless part of your active conduct of the trade or business. Another couple notes on this. The QBI deduction is generally going to be up to 20% of QBI. That could be subject to limitations and phase-ins that we'll go into. It is a below-the-line deduction that reduces taxable income, but not AGI, and it's also not an itemized deduction. If you do, for the carryover of losses, if the net amount of the deductions for qualified trades or businesses is less than 0, then the loss will carry forward to the next year and will reduce the QBI deduction in the following year. Just kind of a heads up on this, it's hard to discuss QBI without getting into the technical aspects of it. There's just no good way to explain it. So I'll try not to put everybody to sleep, but just be aware there is a lot of statutes and code sections in here just because we don't have much to go on currently except for what was written in the new statute. So jumping right into what the QBI deduction is. So I'm going to read this. It's the lesser of the combined qualified business income amount of the taxpayer, or 20% of the excess, if any, of the taxable income of the taxpayer for the tax year over the sum of the net capital gains and the aggregate amount of the qualified cooperative dividends of the taxpayer for the tax year. For B there, it's generally 20% times your taxable income excluding your capital gains. So you come up with that, and then it's plus the lesser of 20% of the aggregate amount of qualified cooperative dividends of the taxpayer, or taxable income excluding net capital gain for the tax year. The amount shall not exceed the taxable income reduced by the net capital gain. I'm not going to spend much time on bullet point number 2 there because it doesn't apply too often to mortgage banks. We're mainly going to look at 1A, which is the calculation of combined qualified business income amount. You can kind of think of this as your tentative deduction under 199A, of which may get limited by some wage and property factors. For 1B, which is 20% times your taxable income less capital gains, generally that would apply if you had large charitable contributions, losses from other sources on your personal return, or large capital gains in relationship to your taxable income. And that would kind of make sense if you had a lot of long-term capital gain. They don't want you getting a 20% deduction when you're already getting a preferential treatment as far as tax rate goes on that long-term capital gain. So looking at 1A, combined qualified business income is the lesser of 20% of the QBI for a qualified trader business, or the greater of 50% of the W-2 wages of the qualified trader business, or 25% of the W-2 wages of the qualified trader business, plus 2.5% of your unadjusted basis immediately after acquisition of all qualified property, plus the 20% of the aggregate amount of qualified REIT dividends and qualified PTP income. A quick note, for the 50% of the W-2 wages or 25% of the W-2 wages, we've had a lot of questions come in thinking that's the taxpayers' W-2 wages. Those are actually the allocable amount of W-2 wages to the owner of a pass-through entity. So if you were the owner of an S corporation and you own 20% of the S corporation, the S corp paid $1 million in wages to their employees, your allocable share of W-2 wages would be 20% of the million, or $200,000. For these, we're going to focus on 1, the 20% QBI qualified trader business. And then on the 2A, we're going to mainly focus on that, since for mortgage banks, the unadjusted basis of qualified property typically doesn't come into play with the amount of wages that you have. 2B would be more for your typical real estate holding companies that don't have many employees. They would be using that one in terms of getting the greater of. Near the end of the presentation, we're going to discuss what actually is a qualified trade or business, and that's what's going to matter to a lot of you in order to qualify for this deduction. Let's look at a quick example applying those factors. So a married taxpayer receives $500,000 of ordinary income from a qualifying pass-through entity. The taxpayer's share of the allocable W-2 wages of the pass-through is $250,000. The taxpayer individually has separate W-2 income of $100,000. So just walking through the steps that we showed on the last page, you'll come up with your combined QBI, which is the lesser of 20% of your QBI. The K1 income that would have shown for the taxpayer would have been $500,000 of ordinary income. We'll multiply that by 20% and get $100,000, or the greater of 50% of your W-2 wages allocable to the taxpayer, which would be $250,000 times the 50%, or $125,000. As you can see, bullet point 3 there won't come into play. So then we'll go to the next step and say, what is the lesser of the combined QBI, which is $100,000, or 20% times your taxable income, which for this taxpayer, we're using taxable income as $500,000 of ordinary income plus his $100,000 of wages. So the lesser of would be the combined QBI of $100,000, and so this taxpayer would get a deduction of $100,000. Taking a quick look at a second example, the exact same facts as example 1, except the W-2 wages allocable to the shareholder are only $100,000 instead of the $250,000 from before. Going through the same type of steps, the 20% of QBI is $100,000, or the greater of 50% of the wages. So in this case, the wages under this formula is $50,000. So the lesser, so your combined QBI would actually fall into the wages category, and you would have $50,000 of wages as your QBI. Take the lesser of that, or 20% times your taxable income of $120,000. So in this example, the deduction would only be $50,000. We're going to take a brief break here to answer a poll question, and we'll be back in 30 seconds or so. All right, we are back. So now we're going to move on to discuss the exclusions and phase-in of the wage and property limitations. This can get pretty confusing, so you'll have the slide deck to go through, to kind of look at these examples maybe in more detail once you get those. So when I'm talking about the wage and property limitations, we're going back to that last formula and looking at the part that says the greater of 50% of the W-2 wages of the qualified trader business, or 25% of the W-2 wages of the qualified trader business, plus 2.5% of the unadjusted basis of your qualified property. So if a taxpayer has taxable income less than $315,000 for a married filing joint person, or $157,500 for a single, then the wage and property limits do not apply. All you would have to do is take 20% of your QBI, the first part of that formula, and that's what you would apply. However, if taxable income is between $315,000 and $415,000, and the wage and property limit, A and B above, are less than 20% of the QBI, there's going to be a phase-in on the wage and property limit. I'll get into more detail on that in a second. If a taxpayer has taxable income greater than $415,000, then the wage and property limits are in full effect, and you would use the formula just as we did in the previous examples and take the lesser of 20% of your QBI or the greater of 50% of your W-2 wages, or the 25% of wages and 2.5% of your unadjusted basis of the property. So kind of looking at this big picture, what are they trying to accomplish here? The objective of this phase-in is to allow your lower income taxpayers who are under $315,000 to receive the full benefit of your 20% QBI deduction. High income taxpayers are only allowed the 20% QBI deduction if they have over $415,000 of taxable income. And they're only allowed the 20% QBI deduction if it's lesser than your W-2 wages or property limitations. Otherwise, their deduction is going to get limited to whatever the wage or property limit is. However, for that taxpayer that falls between $315,000 and $415,000, the wage and property limits phase in. So if the taxpayer's 20% of QBI is greater than the wage and property limits, then the 20% of the QBI is going to be reduced proportionally by however much the taxpayer's taxable income exceeds the base amount of $315,000. So I know that's a lot to handle. If a taxpayer had $365,000 of taxable income, he's 50% of the way between $315,000 and $415,000. So if the 20% QBI exceeds the wage and property limits by, say, $40,000, then instead of getting the full 20% of their QBI as the deduction, the 20% QBI deduction is reduced by $20,000, or 50% of the $40,000. Let's look at an example, and I think it'll make more sense. So here, a married taxpayer receives $390,000 of ordinary income from his qualifying pass-through entity. The taxpayer's share of allocable wages from the pass-through is $50,000. So following the same steps we did in the previous example, let's look at 20% of your QBI, and that's $78,000. And then you look at, or the greater of 50% of the wages, which is $25,000. So first, you can see that 20% QBI is greater than the wage and property limit, which is the 78,000, is greater than the 25,000. Next, obviously, their taxable income is $390,000. They're in between the $315,000 and $415,000. So there will be a phase-in of their limitation. So there you'll see the excess percentage, which is 75%, which that represents the fact that $390,000 is 75% of the way to $415,000 when looking at $315,000 as your base amount. The benefit the taxpayer is receiving on the QBI is $53,000, and that's just looking at if they were to be a high income taxpayer, they would have to take the lesser of 20% of QBI, 78,000, or the greater of 50% of their wages, which was $25,000. So if they were a high income taxpayer, their combined QBI would be the $25,000. So they're receiving a $53,000 benefit if they can take 20% of the QBI. So the phase-in is calculated by taking that $53,000 benefit and multiplying it by that excess percentage of 75%, which is $39,750. Therefore, the QBI deduction after the limitation would only be $38,250 because you're reducing your $78,000 by that phase-in on the wage limit. I hope that made perfect sense to everybody. Now we're going to move on to the definition or what is a qualified trade or business, because the QBI, as you recall, is the net income from a qualified trade or business. A qualified trade or business is defined as a trade or business other than a specified service trade or business or wages earned as an employee. On these next few slides, we're going to get pretty technical, just because we have nothing to go on as far as guidance except for the literal words that are written down. So we're going to kind of walk through the words written down and do our best to interpret them, or at least understand what they're trying to get to as far as who qualifies as a specified service, trade, or business. We've had discussions with the MBA on this topic. They're actually, we know, reaching out to DC to get more clarity on what businesses should be included as a specified service, trade, or business. We actually saw last week the AICPA sent a letter to the IRS and Treasury requesting more information on 39 areas of this new tax reform bill. Their number one question on this was getting more guidance on what businesses are to be included as specified service, trades, or businesses. Hopefully, some Treasury regulations or more guidance comes out sooner than later. We've heard rumors that they're in the works, but we have no idea when they're actually going to be published. Overall, there's just a lot of uncertainty in this area, but here's what you have to go through, at least at this point, with what's written in the code to determine whether the business that you're running qualifies as a specified service, trade, or business and will be subject to the limitations as such. So a specified service, trade, or business means any trade or business which is described in 1202 E3A without regards to the words engineering and architecture or which would be so described if the term employees or owners were substituted for employees therein, or which involves the performance of services that consist of investing and investment management, trading, or dealing in securities as defined in Section 475(c)(2), partnership interests or commodities as defined in Section 475(e)(2). So let's look at these, each A and B here, a little closer. When we take a look at A, it asks to go to 1202(e)(3)(a), which says, any trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners. So the big question concerning us is whether financial services is meant to capture mortgage banks. What is meant by the performance of services in financial services? How broad or narrow are they trying to interpret financial services? Is it meant to capture wealth management, money managers, financial advisors, insurance companies, currency exchanges? You could be inclined to define it somewhat narrowly, considering the slide we previously showed where Part B of that 199 statute specifically mentions investing, investment managing, and trading. So why would Part B of the statute even be needed if financial services already captured these businesses? Secondly, if you actually were to look in the tax code under 1202(e)(3)(b), that section states any banking, insurance, financing, leasing, investing, or similar business. So why did they feel like they needed a section B under 199 when it seems to encompass 1202(e)(3)(a) and B would cover a similar field of companies? Kind of finally, to emphasize the point of how vague these statutes are and how wide a net they may be casting, just read the last sentence on the slide where it says, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. I can think of a lot of industries that this might be the case that I don't believe they're probably trying to capture, such as a car mechanic or a hairdresser that could fall into this category. And are they trying to capture those people? It's hard to determine. If we continue to look at 199, the section B under specified service trade or business, this one says, which involves any trade or business which involves the performance of services that consist of investing and investment management, trading, or dealing in securities as defined in 475(c)(2), partnership interests or commodities as defined in section 475(e)(2). I guess, first of all, the statute begins by saying specified service, trade, or business involves the performance of services. You have to give some consideration to the fact that they specifically mention performance of services instead of leaving this phrase out and just saying a specified service, trade, or business consists of these items. It's possible to interpret the intent of including the performance of services in order to emphasize the fact that the trade or business must be providing one of these services to a client or a customer. So as many of you know, mortgage banks are classified under the Internal Revenue Code as dealers in securities because they regularly purchase or sell securities, loans. However, the dealing in securities is really an internal function of a mortgage bank, which engages in selling loans to the secondary market for the benefit of the company, not a client, consumer, or borrower. So you could argue mortgage banks are not dealing in securities when it comes to their borrowers, clients, and customers. They're dealing in securities as an internal function. Therefore, they aren't performing services when dealing in securities as intended by the statute. I guess moving on, looking at the way the statute's actually written, it states the performance of services dealing in securities as defined in 475C2. If you look at 475C2, this is the section that actually defines a security. Section C1 defines the dealer in securities. So if the statute was actually meant to capture any businesses that are classified as a dealer in securities, wouldn't the statute just say businesses classified as dealers in securities under 475C1 instead of using C2, which defines securities? So that's kind of a guide to the way that we're trying to interpret this and how you should go about trying to interpret this until there's more guidance in the area, and you can see how difficult it is to try to interpret their meaning or really what the purpose of them was and who should be included and who should be excluded. So what does happen if your trade or business is classified as a specified service, trade, or business? If your taxable income is less than $315,000, then the limitations on a specified service, trade, or business don't apply. So you would follow the general rules, take 20% of your QBI, and you're not subject to your wage or property limitations. If your taxable income is greater than $415,000, there is no Qbi deduction, so you don't even need to bother with it. However, if your taxable income falls between that $315,000 and $415,000, then the limitations apply for a specified service, trade, or business. And the way they break this up is by giving you what they call an applicable percentage, which basically reduces your QBI and your wage and property calculations by however much your taxable income exceeds that base level of $315,000. So it's similar to that calculation that we did before. However, the wage and property phase-in does continue to apply. So we'll take a quick look at an example here. This is the exact same example as before. However, this would be under a specified service, trade, or business. So we would do the same calculation as before and come up with the fact that 20% of your QBI is $78,000, 50% of your wages is the $25,000, and now we would apply the applicable percentage to this. The applicable percentage being 25% because you're 75% of the way through your wage limit from $315,000 to $415,000. So apply the 25% to everything you calculated originally. So your 20% of QBI is reduced to $19,500, and your 50% of wages is reduced to $6,250. Then we have to apply the wage and property phase-in limits, as we did before. So we'll look at the excess percentage, which is 75%. We'll look at what benefit you're receiving by getting the 20% QBI over your wage limit, which is the $19,500 compared to the $6,250 of $13,250. And then we'll look at the phase-in of the wage limit being 75%, of the $13,250 or $9,938. So reducing your QBI deduction of $19,500 by that amount gets you $95.63. So a quick comparison to example 3, you can see as a qualified trader business, you would have been entitled to a $38,250 deduction. As opposed to a specified service trader business, it would only be $95.63. And now we'll do a second poll question, and then I'll be handing it off to Kenny to discuss the S2C Corp conversion topics.
All right, welcome back. The correct answer to that question was C. So as Josh mentioned, we're now going to move on to S2C conversions. Just as a caveat, thank you, Josh, for all that. We appreciate it. I think we're all lucky to have a CPA that can make that calculation so that we don't have to go through the brain damage of trying to calculate it ourselves. So again, my name is Kenny Birch. I'm going to be talking about S2C conversions. I just want to be upfront with you and let you know that I'm not going to be able to give you a definite answer today on if your entity should convert, but I think that it is something to think about. There's too many factors to consider in an analysis to just provide a blanket statement. However, we'll analyze each situation individually on a case-by-case basis and hopefully be able to work together to come to, a decision on what should be done. My goal today is just to provide you some insight on the factors that should be considered, and hopefully that'll spur some additional thought as to if you should be making this conversion. The last thing that I want to say is just a caveat is before any final conversions are made, definitely please consult your tax advisors, as it's always a good practice to loop them in on any decision. So let's get started. The first thing we're going to cover is the new effective tax rates as a result of the new tax reform. So for C-Corps, the effective blended rate would be 26%, and what that makes up is a 21% federal rate, less a 1% state tax benefit, and then plus a 6% estimated state rate. Please keep in mind that these rates can change depending on the resident state of the owner, as well as where the taxpayer is apportioning income. For example, if you're apportioning a significant amount of income to California, your estimated state rate is going to be higher than the rate listed here because California taxes mortgage originators operating as a C Corp at 10.84%. Next, we're going to look at the C Corp dividend rate, which is effectively 29.8%. What that is a 20% federal rate plus a 6% state rate and a 3.8% net investment income tax rate. Then we'll look at the combined C Corp rate, which is about 48.10%. And what that shows us is just the effective tax rate incurred as part of the double taxation that's incurred by C corporations. So next we'll keep moving is the S corporation shareholder rate, which is 35.6%. And how you get there is the highest individual rate of 37% times the 20% QBI deduction plus the 6% estimated state rate. Again, keep in mind that this effective rate is based on the highest individual rate of 37%. If a taxpayer does not qualify for this highest rate bracket, the difference in effective tax rates is smaller than what is shown here. Also, This is just another reason a conversion has to be analyzed for each company's specific situation, because you may not be in that highest tax rate. You know, another thing to mention here is that the home state of the taxpayer can again play a role on this effective rate. You know, if you're in a state like California, New York, Oregon, you know, really any state that has a highest marginal rate above 8%, you know, the blended rate you see here is going to be a little bit higher because of those states that impose a higher tax. Then finally, the last thing we have is just SCorp state rate for entity taxes. And really this is variable based on state activity. You know, a good range is anywhere from 0 to 3%. You know, again, to use California as an example, if you're apportioning a significant amount of income to the state, your effective rate is going to be closer to 3%. However, if you're operating or apportioning income outside the state of California, your effective rate would be lower. So now we're just going to take a quick look at a tax rate example so we can kind of put hard numbers to the rates that we previously mentioned. In this example, a taxpayer earns $1 million in taxable income in the current year. So if you're a C Corp and we're assuming no distributions were made, you'd be looking at a tax of $260,000, and all that is the $1 million of taxable income times the 26% blended rate. Next, let's look and say, okay, the same C Corp distributes out all earnings, and the tax you're looking at there is about $480,520. What that represents is the $1 million of income less the $260,000 of income tax paid times your 29.8% blended dividend rate. And so once you get that, you're at about $220,520, and then we'd add in the $260,000 to get back to the total of $480,520. On the flip side, let's look at what the total taxes would look for an S-Corp or a flow-through. And what you're looking at there is about $371,000. And to get to that number, we took the $1 million of taxable income times the 35.6% individual rate to get to $356,000. And then on top of that, you're looking at, we just used a medium rate right there, just right in the middle of 1.5%. To add in the estimated entity state taxes, and that's how we get to the total of $371,000. You know, please keep in mind this is definitely a very high-level example, and it does not include all factors necessary to make a conversion analysis. You know, one thing that can't be ignored is the accumulated earnings tax that's imposed upon C Corps, and what that requires is just support for employing a zero distribution or dividend strategy, and we'll talk about that a little bit later. The other thing I wanted to note here was, you know, as you can see from the example, one of the major factors in determining the total taxes paid by entity type is the distribution strategy. And, you know, we'll dive into that a little bit further on another slide, but it is something to note on this slide that the dividend or distribution strategy plays a significant role in the total taxes paid. So the next thing we wanted to cover was just kind of a simple analysis of C Corps versus pass-through entities, and we'll look at advantages of C Corps, disadvantages, and then also advantages and disadvantages of pass-throughs. So the first advantage we have listed here is just the ability for a C Corp to have multiple classes of stock. You know, this allows for stock to be issued with restrictions on voting rights, priority of paying out assets and dividends, other things like that. So second, we would have greater flexibility for eligible shareholders than that of what an S-Corp can have. You know, a C-Corp does provide a little bit more flexibility when we're starting a business, if you're planning to grow, expand the ownership, or if you're looking to sell your company. You know, S-Corps are really restricted to who can be a shareholder, and so you may have a larger pool of potential purchasers if you are structured as a C-Corp. Next, we have minimizing compliance obligations at the individual level. So because shareholders of a pass-through entity create a filing requirement in any state that the entity sources income to, they have a larger compliance obligation at the individual level than a C-Corp. You know, a C-Corp handles all the state tax filing requirements for the income generated by the entity at the entity level. So therefore, there's a lot less obligations at the individual level when it comes to tax compliance. The next advantage we have would be lower federal and state effective tax rates. What this does, it allows the company to retain earnings inside the company as opposed to having to pay out larger tax amounts as distributions to the owner in order to cover the tax obligation they have at the shareholder or partner level. This will again allow you to grow the company faster by being able to reinvest these earnings in the company. And then finally, the last advantage we have would be the fiscal year end option. So generally, pass-through entities are required to have a calendar year end. However, C corporations are allowed the flexibility of adopting a fiscal year end for tax purposes if there is a reason for doing that. The next thing we're going to look at is CCorp Disadvantages. The main one and the big one here that you've heard me harp on a couple times is just this double taxation on the earnings distributed. And just to mention as well as if you have an asset sale. And what that double taxation includes is the income tax that you're paying as well as the dividend tax. It's just something to keep in mind that is a big factor when analyzing the potential to be operating as a C Corp. The next one would be the applicability of net investment income tax upon distribution of earnings and liquidation. So distributions are subject to net investment income tax and therefore taxed at an additional 3.8% at the individual level. And then finally, the last disadvantage we have listed here would be that there's no easy conversion back to a pass-through entity. So if you're an S-Corp that revokes your S status, you must wait 5 years to re-elect that S status. Also, for a partnership reverting back for tax purposes, it generally requires a taxable liquidation. So now let's move on to the pass-through advantages. The big one here is obviously the tax-free distributions to the extent of basis. So to the extent that the shareholder has basis, distributions from a pass-through entity are tax-free, which allows earnings to be distributed while avoiding, the double taxation effect that C Corps are subject to. The next pass-through advantage would be, as Josh mentioned, the potential for the QBI deduction. As a reminder, that does sunset in 2025. But shareholders and partners in pass-through entities can take care of the advantage of the new QBI deduction. As we saw on the effective rate slide, this results in a lower effective tax rate as opposed to if the QBI deduction is not available to the shareholder. Next, we have partnership allocations. Partnerships have the ability to allocate income and loss based on the agreement between the partners. So this allows greater flexibility when drafting an agreement for the partnership. Along those same lines, we also have as an advantage is partnership distributions. Similar to the partnership allocations, partnership distributions are not required to be made pro rata to ownership. And this allows partnerships greater flexibility in determining when they want to pull earnings out of the company. So the next thing we have would be that all income is passed through to the partners or shareholders and the tax is paid at the individual level. Pass-throughs generally are not taxed at the federal level unless they have a built-in gains tax. This allows the pass-through entities to distribute earnings to members to pay the tax as opposed to being responsible for paying the tax at the entity level. And it also allows you to avoid, again, that double taxation effect. Next, we have flexibility in tax reporting options for partnerships. So for a partnership, you have the ability to be taxed as a partnership. You can make an election to be taxed as an S-Corp, or finally, you can make an election to be taxed as a C-Corp. So a lot of flexibility there that you can take advantage of. And then finally, you also have highly flexible management structure for partnerships. And all we're getting at there is that, pure corporate law does not apply. And you have a little bit more flexibility when structuring your agreement. Okay, so the next thing would be just the disadvantages of a pass-through. As we mentioned, there are restrictions on eligible shareholders for an S corporation. S corporations are restricted to no more than 100 shareholders, and the shareholders must be U.S. citizens or residents. S corporations cannot be owned by C corps or other S corps, LLCs, partnerships, or many trusts. Also, S corporations can only have one class of stock. The The caveat there would be you do have a disregard for the voting rights, while C-Corps can have multiple classes of stock. So the second disadvantage that we have listed would be the additional state compliance requirements at the individual level. So as I mentioned, there is a filing requirement generated for any state that you are sourcing income to, and that filing requirement is generated at the individual level. Unless a composite return is filed on the member's behalf, the individuals would be required to file in each state. So there is, again, just some additional tax compliance as a pass-through at the individual level. Third, what we have here is just additional compliance in regards to tax distributions if members are in different states. What we're referring to there is just a true-up distribution. So if you have a member in one state and then another member who is a member who their home state is, different from the first member, there could be differences in tax rates there. Because these distributions are required to be made pro rata, you may need to do a true-up distribution calculation. It's not extremely difficult, but it is something that is just another item to consider as a pass-through entity. And then finally, as I mentioned, S-Corps are required to have proportionate distributions. This is actually an advantage of the partnerships, as we mentioned, but they're required to make distributions proportionate to ownership percentages. So if distributions are not made proportionate to ownership percentages, the IRS could conclude that the entity effectively has two classes of stock and revoke your S election. It's not a huge likelihood, but it is something that should be taken seriously and considered to make sure that you do have pro rata distributions in order to avoid your potential of having your S election revoked. So we're going to come to our final poll question here. Please take a minute to provide an answer, and we'll regroup in about 30 seconds. All right, thank you guys for submitting those answers. The correct answer was C, 37%. So now we're kind of getting into the meat of this and the factors to consider in the conversion analysis. The first one we want to make sure you guys consider is income projections, and that would be through the date of exit. Where this comes into play is higher income levels will mean greater tax savings, assuming no distributions at the C-Corp level. Also, if you have a taxpayer in a lower rate bracket, this could mean that lower taxes that would shrink the spread between the 26% effective tax rate for C-Corps and the 35% effective tax rate for individuals. Next factor we want to consider would be the exit strategy. The company should definitely consider the exit strategy when considering a conversion. The structure of the transaction, meaning asset sale or stock sale, as well as the purchase price, are two of many factors to consider in this area. Many of the transactions we see are structured as asset sales unless the buyer is needing to purchase a license. So next we get into distribution strategy, and as I mentioned, this is, while it can't be considered in isolation, it is a major factor for the conversion analysis. So because of the double taxation effect that is incurred on earnings distributed as a C-Corp, it's a big factor that comes into play. If the company plans to retain all earnings in the company in order to foster growth and increase equity, it may make sense to convert so long as all your other factors are considered. Conversely, if you're thinking about if you're happy with the growth of the company and the owners are ready to start stripping earnings, a pass-through structure may be more beneficial in order to avoid the double taxation. But again, we've got to include all these other factors. Now, the last point I want to make here is that C-Corps do have to consider that accumulated earnings tax and its implications that I mentioned earlier. While a taxpayer, you may think, oh, we're not going to distribute anything, the taxpayer is required to substantiate that strategy. So this would include supporting reasonable needs of the business because of growth or other business needs. But if substantiation cannot be made, the CCorp is going to be required to make reasonable distributions if you can afford to do so. The next factor we're going to consider is the QBI deduction implications. As Josh mentioned, there's still a lot of uncertainty surrounding the qualified service business definition if it's meant to capture mortgage originators. If mortgage originators are deemed to meet the definition of a qualified service business, it will become more enticing to switch as the difference in effective tax rates for C-Corps and pass-through entities will widen. However, if it is determined that they do not meet this definition, then the decision to convert does become a little bit, more complicated. The next factor we're going to consider is going to be future tax reform. So will tax rates stay at 21%? Unfortunately, there's no guarantee that future tax reform will not be passed. This new tax reform could adjust rates and result in less favorable tax treatment for C-Corps. For one example I wanted to bring up was the 86 Tax Act, which is really the last time we've seen major tax reform. The highest individual tax rate was 28%. Now in 2017, we saw that the highest individual rate was 39.6%. So, you can see right there that rates definitely change over time, and there's no guarantee that this wide spread that we're seeing is going to last. The last thing I want to mention there is, if you do revoke an S election, you are required to remain as a C-Corp for 5 years. So future tax reform, if it's changed in the next 5 years, you could end up with some, unwanted tax consequences. Next thing we'll look at is the tax rate by bracket. Throughout this webinar, we've kind of assumed that the highest tax rate would be applicable. However, if an individual does not fall in that highest tax rate, the difference between the effective C-Corp rate and the effective pass-through rate would shrink and make a conversion less attractive. Moving on, the next factor that we'll consider is kind of the current deferred tax asset or deferred tax liability position of the company. Taxpayers that convert to C corporations will experience a one-time, significant event of booking the deferred tax asset or deferred tax liability. Most mortgage companies that we see, do have a significant deferred tax liability position, which could result in a big hit to tax expense in year one. So 2 more factors we want to consider. The first one being ROI on tax savings required to offset the eventual double taxation. As we've mentioned, eventually the earnings inside the C-Corp are going to be subject to a double taxation once they're distributed. Therefore, the taxpayer must analyze what ROI is required on the tax savings to out-earn the double taxation that's eventually going to be imposed upon the dividend distributions. And then finally, the last factor to consider would just be non-tax reasons. We realize that taxpayers may have non-tax reasons for converting to a C-Corp. These might include flexibility of investors, upfront savings, etc. So just keep that in mind, and these factors should be considered before a final decision is made on conversion. So real quickly, we're just going to look at what the conversion process looks like for an S-Corp, and then we'll look at it for a partnership. So step 1 would be a shareholder vote. Internal Revenue Code requires a group of shareholders that own more than 50% of the corporation's outstanding stock to agree to terminate the S-Corp status. So keep in mind, you still have to comply with your own bylaws, which may mean, giving proper notice of the vote and actual holding the vote. Step 2 would be submitting a letter to the IRS stating your intent to revoke your S election. And included in that letter is just a statement of consent that's got to be signed and dated by all taxpayers. That form has to be mailed to the IRS. And for more information on that, just see the instructions for Form 2553. 2 other things on this slide is just as I mentioned, we haven't quite mentioned this yet, but in order to revoke retroactive to January 1st, 2018, the letter must be submitted by 3/15/2018. Elections can be made at any time during the year, but will not be retroactive to January 1st, 2018, unless it's filed before March 15th, 2018. And what that entails is just a short period SCorp return to capture the activity up until the date that the S status was revoked. So for partnerships, it's quite a bit simpler. Really, all you got to do is it just requires an incorporation or check the box election, unless you have special allocations that must be addressed before converting to a C Corp. So finally, to kind of wrap this up, we wanted to provide kind of Richey May's thoughts on conversions. You know, we would suggest that companies avoid any panic planning and instead wait for further clarification on the newly passed tax reform. You know, while an analysis can currently be performed, we feel as if it would be an incomplete analysis without further clarification on, you know, things like the QBI implications for mortgage originators. So currently, indications are that regulations may be issued sometime around June or July. So with so many factors to consider in the conversion analysis, we suggest that an analysis be performed after these regulations or any other interim guidance is issued in order to give the taxpayer a better understanding of all implications surrounding the conversion process. You know, finally, taxpayers should consult their tax advisors before any final conversion decisions are made, even if that decision is being made for non-tax reasons. So that really wraps up what Josh and I had today. I'm going to turn it over quickly to Jared to close us out right here, and we'll all be free to go. Thank you, guys.
All right, thanks to Josh and Kenny for the webinar today and talking about these key issues under the tax reform. Just to wrap up, you know, due to the fact that we're out of time, we're unfortunately not going to be able to answer any of your questions today, but we want to let you know that we have captured those, and we will follow up with each of you directly following the webinar. Also, a reminder that following the webinar, you'll see a survey appear, and if you could complete that survey, we'd really appreciate your feedback on today's webinar. CPA certificates of completion will be emailed to participants who qualify in the next few days, so look in your email for that. And a recording of today's webinar and the slide deck will be provided to all participants following the webinar. Again, we certainly appreciate your time today. Hope you found today's webinar valuable, and we'll talk or see you soon. Thanks. Bye.